Hello, everyone. My guest today is Lauri Klaus with extensive leadership experience. She's the CEO and co-founder of KeyedIn, a Minneapolis-based company that helps organizations simplify business processes, improve performance, and drive results through its innovative SaaS-based business solution. Before she founded KeyedIn, she held various senior management positions at Epicor, most recently as Executive Vice President, Worldwide Sales and Services. Lauri, you ready to take us to the top?
Absolutely. Let's go for it.
All right. The project management space is hot. We can't talk about it without talking about Monday's most recent $150 million round at a $2.9 billion or $1.9 billion valuation. There seems to be so many $100 million winners, though, in this space. You're playing in it. How are you differentiating?
Well, first of all, we differentiate by a lot of new innovations as well as being native cloud and, founded 7 years ago. So we started with just PPM and have now grown
to PPM?
Project Portfolio Management. So we focus on PPM for project management offices, as well as professional services automation, primarily for embedded services organizations. So if you look at any software company, they would have a services organization, and that's where we fit very well.
Okay, interesting. These are like for a SaaS company, a lot of them have service organizations that do the onboarding, for example, or you would serve that team.
Correct. Yep.
Okay. And can you maybe, I know it's hard without actually visually showing the UI, but what about your product makes you the best fit for those kind of onboarding teams?
Well, we're very flexible. We've got the right balance between best practices as well as being flexible so that people can build their own dashboards and really find the information they need to make decisions on a timely basis before it's too late. You know, these companies have millions and millions of dollars of projects that they're working on, and resource management, organizational management, being able to do that makes companies much more efficient and ultimately saving millions of dollars a year. And at the end of the day, everyone wants successful projects. They want them done on time and within budget, and it's really tough to do. Yeah. I ran a software company. We had 3,000 employees.
Which one?
Epicor.
Okay.
I had 1,500 employees. We had 300 projects going on a monthly basis, and it was very easy to sweep things under the carpet and ignore, bad disciplines. So it's really important, and it's growing. I would agree with you.
So give me a general sense here. I'm sure you have hundreds of different customer cohorts, but for the sake of time, what would you say your sweet spot is? What's the average business going to pay you per year to use your technology?
Yeah, so we've really got two unique groups. One is large organizations, enterprise, like Walgreens, Boots, Specsavers, large companies where they've got IT organizations and they have project management offices and are running hundreds and hundreds of projects. So that's going to be somewhere around, $300,000 to $400,000 a year in annual contract value. On the other side, the embedded services organization, it's closer to 100,000 a year. But all in all, it's about 350 customers that we have, growing from, when we founded the company, we had about 40 that were acquired. So,
sorry, what do you mean? Since you founded, 40 were acquired?
We acquired a company 7 years ago, and they had about 40 SaaS customers. And since then, we've grown to about 350.
Oh, great. Okay. So I want to capture more of your founding story. There's a lot of people that say it's actually smarter to get started by actually acquiring something. You avoid the 0 to 1 and focus on the 1 to 10. So let me go back to that in a second. But first, I want to repeat back to you to make sure I got this right. So you have two cohorts, one about $100,000 ACVs, and then a more enterprise version at $300,000 to $400,000 ACVs. But everyone's north of $100,000 a year.
Pretty much, yes.
That's great. Okay, very good. And then, so take me back to the founding story. So you're at Epicor. When did you decide it's time to pull the trigger and leave that safety net and go all in on your own thing?
Well, I was at Epicor for 22 years, so I grew up there. We acquired 16 companies, brought them together, so have a lot of experience bringing companies and cultures together. It was all in the on-premise world, and we knew that the next evolution was cloud computing, and we sold Epicor for just under $1 billion and used some of those funds to found KeyedIn to focus 100% on business-to-business cloud computing. Okay. Definitely know a lot of the pain points and lots of great experiences, but we were able to start from scratch to build environments to avoid, a lot of those pain points like infrastructure. I mean, that's one of the biggest pain points that any on-premise will have.
So Lauri, which company did you buy back 7 years ago?
Oh my gosh, we bought 16. So Clientele, Claris.
Sorry, the one that you started KeyedIn as, the one that you bought to kick.
Okay.
Yeah.
Whoa, you're taking me way back.
Yeah.
No, we acquired a company called Atlantic Global, and we're a publicly traded company. We also acquired a platform as a service, so we have our own platform, independent of any, like a Salesforce one or anything like that.
Mm-hmm.
And then we also acquired, we have a smaller group for custom manufacturers, and that's a third market that we go after. But we're independent in terms of platform. We're aligned with Microsoft and Microsoft Azure as well.
What was the beachhead though of the code base? It was the Atlantic Global acquisition.
Yes. Mm-hmm.
Okay, so that was a publicly traded SaaS company. At the time of their last reporting on the public markets, what was their revenue?
It was about 800,000.
Why were they public? So small.
They went up and down. So they probably at their
99 and
yeah, that was their low point, which is why they wanted to sell. They had just re-architected their product a couple years prior, so it was a technology buy. We bought the technology because it was native cloud computing for projects.
So what'd you pay for it all in to get going?
I'd rather not disclose that, but what I will say is we've funded the company with funds from the sale of Epicor as well as friends and family today, and then we did just have our first round of institutional investors about a year ago, and that was a $15 million raise.
How much total raised in KeyedIn today?
Rather not disclose, but it's significant.
Okay. Yeah. By the way, most of the stuff is public, right? So public records show you raised about $42 million total. Is that accurate?
It's close. Yeah.
Okay. So 42 million. And then again, you took a public company private. So that is also, I have to obviously reveal that, right? So I'm going to let you do it, or I can pull it from the research. I'm just curious, a general range of what you spent to take that private.
About $5 million.
Okay. Yeah. So that's what was reported as well. So help.
Legal fees.
Yeah, which can be big. So 5 million kind of all in. Would you so if I asked you like total cash you guys had to sink all in before you were able to add your own customers on top of the 30 or 40 that they already had, you think it was about 5-6 million with legal fees and then it was all yours?
Right.
Okay. So since then, you've obviously scaled. Now, did you keep of the 350 customers today? Do you still have all 40 or 50 of those ones you acquired back in 2012?
I would say we've got about 80%. There was some cleanup to do.
Yep.
And that was, there were some customers who wanted to be in the on-premise situation, and we were focused on cloud. So we worked with them to transition out. So I would say about 80%.
Yep. This kind of churn, by the way, is natural, right? As you're scaling a company, especially as you're pivoting what your like key cohort's going to be. So when you look at your past 12 months, obviously churn is critical in a SaaS company. You have a lot of experience. What is your churn today, and what are you doing to make sure you continue to lower that over time?
We're in an excellent situation right now. Our net retention is 108%. So our customers continue to invest more.
Well, peel that onion back though for me. So 108 is made up from churn plus expansion, which gives you the 108. What are those two metrics?
It's about 50-50. 50% new, 50% add-ons.
Well, sorry, net revenue retention has nothing to do with new customers you add. It's a measure of the cohort that signed up a year ago, how much of it churned versus how much you expanded that same cohort's revenue. That was my question. So of the 108% net retention, what was churn and what was expansion on the cohort from a year ago?
Well, the churn is about 10%. Okay,
so expansion is about 18% then.
Yeah. Exactly.
Okay, pretty good. And so help me understand the expansion model. When this goes into your product a little bit more, what kind of things are you upselling against? Is it number of seats, or is there a value-based upsell you're upselling against?
A lot of it is we start in one division, and then word gets out and we go into another division. So it's typically large expansions. Some smaller,
But do you have like number of project limits that automatically upgrade people, or other like number-based limits or anything?
Number of resources.
Measured by what? Gigabytes?
Measured by how many people are using the system.
Number of seats. Okay, so upselling based off seats. But again, no number like number of projects, number of storage, there's nothing like that you upsell against?
Storage, we will, once it reaches a certain amount, we will need to upgrade storage,
I
which is
see.
also based on, how much they're using, how many projects they have, but primarily it's based on resources.
I see. Interesting. Okay, and break down the team for me today. How many people total on the team?
100.
100. Okay, and what's the breakdown look like between engineers versus quota carrying folks?
About 50% engineering.
Okay.
And then 25 services, and then the other 25 sales and marketing.
Okay, great. And of those 25 sales and marketing that are left, are they all quota carrying?
We've got about 12 quota carrying.
Okay, interesting. So yeah, you have the reason I'm asking is you clearly have an enterprise sales motion here. These are accounts that are big that you can afford to put touch on up front. How aggressive, Lauri, are you being with CAC? Are you happy with the 12-month payback period or 18 or 24 months? What do you optimize for?
I'm happier.
Good answer.
I'm definitely happier. It's been a major investment to, first of all, acquire the companies.
Yeah.
But then to, in the SaaS model, it's a 2-year investment before you start to get that return. And now we've taken that turn. We entered into our 7th fiscal year, and it's really nice entering into that year with, X amount of revenue already booked. That just wasn't the way of the world in my last career.
Well, it's shifting. The world is shifting. It's a good shift. So just to codify what you just said, kind of 2 months or 2 years when you start to actually make money on a customer. So if you're going to acquire a $100,000 a year customer, what I'm hearing you say is you'd spend up to $200,000 to get that customer in.
All in, yeah. And there's, outliers and all of that. But yeah, pretty much.
Generally speaking, 200. And where's most of that spend going? There's obviously the salesperson commission. Where else?
Sales, marketing, a large amount in engineering. We spend a lot of money investing in innovation into our products to stay competitive and to stay in front. So it's across that platform. But the sales and marketing expenses, solution engineering, and in the early implementations, we did a lot of discounted implementations.
Yep.
And that, of course, costs us money as well. So hopefully that answers your question.
Take me back to 2013. So you're raising capital. You did $2 million raised in 2012, 5.3 2012 again. 2013 raised a good chunk of $16 million, and then another 1.5 venture round in 2013. And then you did something a little bit different. In July of 2015, you did a debt round. Debt's becoming more and more popular across SaaS companies. So I always like to dig here when I can to learn. Why did you choose to do a $2.7 million debt financing in 2015?
Because we were nearing, it's been a real balancing act. I think one of the questions I've heard was has been one of your major challenges, and that is how you balance how fast you want to grow with how much you want to dilute your investors and the window of opportunity. And so to balance all of that, so we looked at the debt instrument as a way of not diluting the shareholders, but adding cash into the company with the option to convert that debt into equity if we weren't able to pay it back.
So it wasn't like a true venture debt. There's an interest rate and repayment cap. This was really a convertible note.
Convertible note, exactly.
Yeah, interesting. Now, did the cap on the convertible note reflect the valuation from 2 years prior in 2013 when you did the $1.5 million venture round?
It was no. It was higher. The valuation was higher.
Okay. If that was, yeah, I mean, most times I see people use debt financing strategically is when they go out to market to raise another VC round and they're not getting the valuation they want for whatever reason. You could have a great company, by the way, and not get the valuation you want. You have a great company, right? And so they do this because they want to avoid a down round. And so usually the caps are typically not as favorable as they would like. Was that the situation you guys were in or no?
Yeah, it was, and we converted all of the debt. So we had zero debt at that time. Converted it all into equity. Actually, at a lower valuation. You're correct, and then raised another $15 million in capital about a year ago. A year ago.
Yeah. Now that valuation though was accretive over the 2013 round, correct?
Correct.
Yeah. So you could argue then you effectively use that $2.7 million in debt to do what you wanted, which is grow the company more to get a higher valuation.
Yep, absolutely.
Yeah, that's great. And then the 2.7 converted with the 15 million from Arrowroot.
Yep, and it really strengthened the balance sheet as well to get the debt off the balance sheet. And
who'd you take the debt from? Was it like a friend or was it one of these traditional kind of venture debt lenders?
It was friends and family.
Oh, okay. Okay, interesting. Would you ever go use venture debt like how we see it today from a Lighter Capital or SaaS Capital or, Timia or any of those guys?
Definitely. We're in the process of we've got about 19 people that we're talking to right now to do that.
Yeah. What do you think, since you're in the research, I've done my own, but I'm curious if our numbers are going to match. When I'm looking at cost of capital on the debt side, what do you feel like the cheapest you've gotten where there's no covenants, no warrants, and no personal guarantee?
Cheapest is hard to say, but the one that's most interesting to me is tied to revenue, royalties.
Revenue-based financing, RBS.
Yeah, exactly.
Yeah. So typically those notes, those facilities,
right? I mean, if we grow our revenue, they get part of that, and it's I think safer on both sides.
What's the cheapest rate you've seen? So typically you're paying back anywhere between 3 and 9% of gross monthly receipts on that over some period of time. What percent have you seen in terms of the cheapest?
Well, I like 3. Where is that?
I know, but what have you seen? What have you actually gotten?
Give me their number.
Yeah.
Actually, it's closer to 8.
Okay. Now the percentage is one thing, but the second thing in order to truly capture the IRR on this kind of facility is to look at what the repayment cap is. So in other words, if you took $3 million loan with a 1.5 repayment cap on a 2 or 3 year term, you're looking at paying back, call it 4.5 million over 3 years as a function of 8% of your gross receipts monthly. What is the cheapest repayment cap you've seen? Is 1.5x about what you're seeing?
That is about what we're seeing. Yes.
Yeah. Yeah. And is it about a 3 year term?
Yep, 3 year term, 3 to 5, but 3 year.
So if there was someone listening right now, I'm going to try and help you out here and create a little bidding war. It sounds like you already have one, but I'm going to try and amp it up here. If someone's listening right now and could get you a better deal than 8% of gross receipts on a 1.5 repayment cap on a 3 year note for something like $3 million, they should call you immediately.
Immediately.
Lauri,
I'll call them.
I get 1%. No, I'm just kidding.
I knew there was something in there.
No, I'm kidding. I generally want to see you get better deals. That's why I do this show in the first place. Okay, good. So that's good. And is $3 million the right amount? Is that what you think you take in?
Right now, we're looking between 3 and 8.
3 and 8. Okay, interesting. Very good. All right, that's all good stuff. And then can we quantify? So I'm going to go back to some earlier numbers you gave me and try and quantify this a bit. You had mentioned that the company today is serving you've grown about 350 customers up from the 40 you started with, and all of them are essentially north of $100,000 ACVs. That would mean that monthly right now you're doing about 2.9 million a month.
So let me correct that.
Sure, yeah.
On the project side, they're, the 100 to the 300 to 400 a year. But half of our customers are in the manufacturing sector.
Okay.
And that's a whole different story. That's, the annual contract value is closer to 25,000.
Okay, got it. So if I just drop that ARPU down, essentially the average down to something like $2,000 a month, that would times 350 customers, that puts you more like $700,000 a month in revenue. Is that more accurate?
You're good.
Okay, just checking. I want to make sure I want to feature you the right way, Lauri. Okay, I'm trying to get you leverage. All right, and then so if that's the case today, where were you about a year ago?
Year ago, we were about under 500.
Oh wow. Okay, I mean, so this is actually fairly good growth. Interesting. Yeah. Why not go do an equity round right now instead of a debt round?
We're trying to balance between. We could do an equity round, certainly could. It's just we've got, the board is a little concerned with diluting current investors, and so we're trying to increase our valuation by getting closer to cash flow break even and profitability, while at the same time continuing to grow. So our plan right now is 25% growth year over year. Yep. With additional funding, we could double. The target markets are huge, yep. But we want to get a little closer to that cash flow break even and to the profitabilities. We think then the valuations will be higher, and we'll have a better opportunity to get
yep.
a better deal.
Lauri, how aggressive are you being right now with burn? You talking like 100 grand a month or $1 million a month, or what's the general range?
It's 300 to 400.
Okay. And do you feel good there? Like, can you sustain that for a while or?
Yeah. Yeah.
Okay.
Well,
That's
we've
good.
come down. We've come down significantly, and that was based on a little bit of a shift in, let's get this valuation up. Let's not dilute right now. Let's build additional proof, and that's what we're in the middle of doing, and it's working. But we definitely are looking at options in the next 6 to 8 months for sure.
What's it down from? What was it at earlier?
It was like $1 million a month.
Okay. Yeah. By the way, not crazy when you raise 15, right? That gives you 15 months of runway ish. But yeah, the hard part is like, it's a balancing act.
It is, definitely.
Yeah.
There were just a couple things that we tried to do that weren't paying off, and we just made the decision to pull away from those and really focus on the areas that are paying off. And it's working. Our employees are super happy, and our customers are super happy as well.
That's good. Very good. Okay. So what's the next big revenue target? It sounds like you're doing right now about 8 or 9 million in terms of ARR. When do you think you break, 11, 12 million?
We're in the middle of that right now. So
okay.
We're double digits.
Good. All right. Let's wrap up with the famous 5. Number 1, what's your favorite business book?
Hope is not a strategy.
Number 2, is there a CEO you're following or studying right now?
Probably, there's more people in politics right now that I'm following than in business. So they were CEOs, but I like Carly a lot.
Yep. Which one? Fiorina?
Yeah.
Yeah. Number 3, what's your favorite online tool for building your company?
Online tool for building our company.
Yep. Besides your own.
We use our own products, so that's kind of hard for me to answer.
Besides that, people have hundreds of tools.
KeyedIn projects.
Which one?
I would say KeyedIn projects. That's our own product, but we're big users of Salesforce.
Okay, good. Number 4, how many hours of sleep are you getting every night?
Not enough. Probably 5, 6.
Okay, and can I ask how old you are?
I am 53.
All right, and what's your situation? Married, single, kids?
Married with a blended family of 8 children.
Holy
adults.
Wow, you are busy. Okay, good. All right, last question. What do you wish your 20-year-old self knew?
Just to believe, and there's a lot of things. It's just, to believe in that next step, and to always just know that if you accomplish that next step, you will grow and you will have opportunities. And it's okay to fail sometimes, because you do learn from that.
Guys, KeyedIn, $700,000 a month right now in revenue, up from $500,000 a month a year ago. So call it 40% year-over-year growth, 350 customers using them to help manage their project. SaaS-based project management tool. Founded in 2012 via an acquisition. They bought another company for $5 million and have scaled it since then. Raised $42 million to date, burning about $400,000 a month. Team of about 100 people full-time. Net revenue retention 108%, with anywhere between a 12 and 24-month payback period on new customers as Lauri looks to scale the company. Lauri, thank you for taking us to the top.
Absolutely. Thank you for the time.